A little bit of a short overview. I think it's some of topics I think will shape not only the year 2015 but also the years to come. And it's always talked about, but demographics will be one of the points that will shape, let's say, I would say, a lot of the investment flows in the coming 5 to 10 years. I would say it's not about next year, but that's the underlying fundamentals that are going with the markets, and we should keep that in mind, despite all the talk about what short-term interest rates and inflation rates and whatever will do. We should have to keep one thing in mind, that demographics is an issue, and what is even more important, is not an issue that affects all European countries in the same way. It affects the countries very differently, and that's the other point we have to keep in mind when looking at the market. From a German perspective, we have to say, yes, we have a declining population, but given the financial crisis, we are actually increasing now. So we can be quite happy about the financial crisis from that side, because it simply boosts a little bit of the demographic workforce we're having. On the other hand, looking at Germany from the inside, maybe not every German is that optimistic about this side of the market. On the other hand, you have countries like Norway that are heavily dependent on immigration, because they simply cannot generate enough workforce on their own. Simply by the fertility is not high enough to generate the workforce that's demanded. So we have to really look at the different countries, and we have to keep in mind that demographics, on the long run, they are the success factor of all the investments, and they will shape in the long run again all capital flows. And although we possibly might now currently look at what's going on, that's the underlying fundamentals we have to keep in mind. And actually that is the great hope we had since Lehman. So we try throwing out money, but it never works. So that's the main point we are still hoping for, looking at the European economy. We have a lot of quantitative easing in the first step with low interest rates, and there's a lot of talk about the ECB now being even more aggressive in trying to kickstart some of the economic problems we are having. The question is, we simply don't know if it's working, and we still can only hope for that it is working. On the other hand, if you look at the overall economic situation, there are some arguments that we can be very skeptical about if it really can only be the quantitative easing side that can work to kickstart and solve the problems we are having. And that is the other side of the coin that makes life for a lot of the investment managers looking for assets quite difficult, I would say. After the introduction of the euro, we have these kind of stability phase where interest rates nearly in all Eurozone countries moved in line with each other. Then Lehman came, and every once in a while we realized that there is country risk. So country risk premia again emerged within the euro area, and after Draghi told that he will do everything possible to save the euro, now the country risk premium seems to fade away again, and everybody again is looking for yield. And where if you don't find yield in government bonds, a lot of investors are looking for alternatives. They're going for real estate, and that is one of the ways that drives a lot of the investment flows to real estate. But we have to keep one thing in mind: we've seen how fast yield spreads can emerge again on the government bond side. On the other hand, we have to keep in mind we've seen a negative trend for government bonds for now, let's say 20-25 years, and there is a natural fall to government bond yields. So if we reach zero, they will not go below zero. So the question is, when will we see the turning point, and what will this mean for property in the medium to long term? And I think that's something that currently drives the investment flows for prime property. But in the medium term, let's say 5-6 years out from now, when interest rates start to reverse, we will have the question: what will this mean for especially secondary or tertiary property, for value add or opportunistic property? Do we really then see the yield levels we currently price in when we do our calculations? On the other hand, what this slide also tells us, that the euro actually will be here to stay. And just to think about this, what is the alternative? Can you imagine to unravel the Eurozone, or how can you make a plan to let one country or two countries exit while the rest remains in the Eurozone? So the convergence story we currently have in government bond yields is here to stay. There might be a phase where government spreads appear again, but it will converge again, because simply the euro will be here to stay, and it will be here in the next years. That's one of the consequences we are still dealing with. after the financial crisis, the growth path of a lot of countries has changed, and that is shaping the underlying economic momentum. You see that the growth rates across Europe are very diverse. You have shrinking economies in some South European countries still. You have growing economies like Germany, but on the other hand, when you look at the German growth rates right now, they are declining. So overall, we are not on that, let's say, strong growth trajectory we have been before the financial crisis. But again, the question will be, how can we get back on this? And that's a structural problem in a lot of countries, and I think these structural problems are not tackled right now. Overall, looking at the, let's say, GDP levels across the different European countries, you see that in a lot of countries we have not reached pre-crisis levels already again. So growth is still lagging the level or GDP production is still lagging the level we've seen in 2007. And it's 7 years out from now, and you see how long that took, and that's some of the underlying problems we still have in the Eurozone or in Europe overall. And the other is inflation and unemployment. I think unemployment, although it's not making the headlines anymore, it's still 20% in Spain and plus. Youth unemployment in a lot of European countries, if you look to France, for instance, is still very high. And that is the underlying problem for a lot of these economies, because they have to solve the problems to kickstart the growth side. Inflation, it's not hitting the headlines either. It's more the deflation question that's hitting the headlines currently. So the question is, how can we really generate inflation and not slip into deflation? Because if you look at these old things, or the inflation rate and unemployment rate in history, unemployment always goes down when inflation goes up. The problem is, if we slip into deflation, there might be a risk of even rising unemployment. So the search for inflation, or the will to create inflation in a lot of countries, might also be a remedy to a little bit of the unemployment we are seeing in some European countries. So will this be the solution? I don't think so, because looking at the European economy right now, the ECB is doing everything from the interest rate side, and also the quantitative easing side. There's a lot of rumor about government bond buying starting early next year. So from that side, the ECB is doing everything. But the question is, we don't have a monetary problem in the Eurozone. It's more like a demand side problem. And looking at the talk about austerity you have still in a lot of countries about balancing government budgets, it's a reasonable thing to do that. But the question is, can you generate demand out of these? And if you cannot generate the demand side out of these issues, the question is, how can you then kickstart an economy? But what is the consequences when you're coming a little closer to real estate? And one of the things when you look at the aggregate level of 25, 30 European office markets is there seems to be no cycle in the current environment. Prime rents are more or less hovering around with very low growth rates. The vacancy rates, they are still relatively high compared to historical perspectives. There's not the clear relationship, vacancy rates go down, interest and prime rents go up. It's more or less, you don't see this relationship we have seen in the last 3 cycles on the European level anymore. So it's not going out to Europe looking for the market where the cyclical position is most attractive and invest in there. It's more like looking for opportunities, not to invest opportunistic, but looking for opportunities that have a real risk-return profile that fits the investor side you're representing, or the investment style you're looking for. So you have to adapt to the local market. You have to look, and you have this core bulb where everybody wants to be, low risk, but that's also the low return side. Although low return relatively now, it's relatively more attractive to low real estate return than in the past. But more and more the investors are looking in the yellow bulb just to look at value add. But you have to be aware of what value add actually is about, because you have the inflation about develop to core, manage to core, build to core, whatever. There is a lot of points that you can make this if you have the good asset manager, but the other thing is you cannot change the location of the property. And a lot of these things that are labeled manage to core, develop to core, build to core, they might not be actually that core in the medium to long term, especially if the economy is not improving as everybody's hoping for. And being in the Netherlands, and also maybe looking a little bit at the Dutch market, as we are also invested in the Dutch market in the summer. Going forward, I think the Dutch economy, it is improving, but it still has a long way to go. It's still improving on a low level. Private consumption has stabilized, as the housing market has stabilized, yes, but it's not that you really now have a self-supporting upswing in the overall Dutch economy that gives you a comfortable cyclical position. And coming from a German company who has a lot of history in the German housing market and also engaged in the Dutch housing market, we're also from a German side are looking at the Dutch housing market finally, and I think you have a little bit of, let's say, a structural opportunity in the Dutch housing market. The transaction volumes are historically low, or have been historically low. They seem to turn the corner right now. You see that political activities support something that's going on in the Dutch residential market, and you've seen investors entering the market. We did it, Roundhill Capital just signed a second portfolio deal last week, so there's a lot of activity in the residential sector, and historically Resi was one of the main institutional sectors in the Dutch market, so that possibly can again be in the future with a little more international involvement. So to sum it up, and everybody can make his mind about these, I want to thank you for your attention and give to my fellow speaker.